All right, very excited to be here today with my friend Phil Stevenson, aka the Mortgage Nerd, and we're going to be talking a little bit about what's going on in the mortgage and financial and economic markets now with the lockdown, the financial stimulus, everything that's been going on. So, Phil, thank you so much for taking the time to be here today and to be true to form and character. So, what a lot of people might know about you, even if they've seen this, is that you pull off this nerd persona pretty well, but you're actually an active duty combat veteran. Did tours in Iraq and Afghanistan, and so tell us a little bit about how a warrior becomes a mortgage nerd.
First of all, Will, thanks for having me. I appreciate it. And everyone's kind of dressed down anyway, but today I decided there's the most exciting day in sports that we've had since this all started with the NFL draft. So
what are sports?
What are sports? Yeah. I saw a really funny video. The guys are like watching a chess match and they jump up, yelling and screaming when someone moves. It was funny. So yeah, a little bit about me, Phil Stevenson, mortgage nerd, trademarked as well now, which is great. And I started, I was originally going to go to the FBI. I wanted to be a forensic psychologist, but I'm colorblind. So when I joined the military to get myself through school, they told me, well, sorry, you're colorblind. All you can do is admin. I couldn't do MP. So I started changing and went to Afghanistan and Iraq, the first tours into both of those. So I always say when we get into talk about recession and economics, I worked for Delta Airlines and I was in the Army Reserve in 2001 when they flew planes in the World Trade Center and the economy collapsed that time. Didn't collapse, but we had that recession. And then, so after my 2 tours, I came back and I said, I'm going to go to college for international relations. Because I want to have an impact on foreign policy. I didn't really like how we were led to believe one thing in Iraq and then it was something different as soldiers going to risk our lives there. Yeah. And but then something changed also in my studies where I said, you know what, let me go and be someone who makes a name for myself and a career and becomes financially independent to then be someone who could network my way into those roles of really having an impact on international relations. So in 2005, I got into the mortgage business. I have a degree in economics, so along with international relations, so it fit right in. And I've always called myself a nerd because I'm actually, I studied amortization schedules and reverse mortgage is very complex. And I studied that. I know the numbers in my head. So that's how I got to mortgage nerd now.
And you've built a pretty good following up on social media, kind of sharing some of the definitely sharing information that most people don't, and and there are a lot of great mortgage lenders and mortgage brokers and stuff. Maybe we'll talk about that a little bit, but we're both fairly highly networked guys, and one of the things that I've always appreciated about you and besides having known you from organizations a while, really one of the reasons I had you help refinance our mortgage was the information and the education that you provide. So if you haven't seen some of Phil's videos, go check him out on Instagram, and I think maybe you share them to a couple of other places, but I know that's where I usually see them.
This background is a video that I put out yesterday because there was breaking news on what the FHFA is and what they're doing that could cause deeper crisis in mortgages. And so I was on the way to the office just to pick something up, which I'm in the office now, so are my kids. We're here alone. And threw it together. It should be like 13 minutes, and it should be put out by the end of today. But that's why I have this behind me, because it's really complex, everything that the mortgage industry entails, and I try to simplify it and put it there. So.
Well, I was going to ask you about it, so but if it's 13 minutes, maybe we'll leave that for the other video. Give me a real quick overview of what FHFA is and what that's going, because that's really where one of the things I wanted to ask you about is help give some people some information about what is going on in mortgage markets, what's happening with all this economic stimulus that's coming out, what's that going to do to rates, to availability, to lending, because there's it's a lot more complicated than just what are the rates out there.
So usually up until the end of February, I have always on one screen the mortgage bonds and the treasuries. That's usually what guides, and the stock market, what guides mortgage rates. People think, oh, the Fed dropped their rates almost zero. That means my fixed rate mortgage is going down, right? No. Sometimes they correlate. Sometimes they both go down or up together, but sometimes one can go down and the other one can go up. But so that whole thing of looking at mortgage bonds and treasuries that I've always done since the beginning of March is kind of out the window, because there's all these other factors. And yesterday's video with this is just explaining how down here you can't see a bunch of little stick figures I drew, but those are the borrowers. The originating company, which is a broker or lender, originates a loan. They sell it to a servicer. The servicer has to make money. The servicer then sells it to, whether it's conventional, to one of these investors, Fannie or Freddie, or FHA, VA goes to Ginnie. And so there's a domino effect. So if these consumers down here aren't paying their mortgage, their forbearance, just because the executive branch and the legislative branches are out there saying there's a CARES Act, you don't have to worry about anything. Well, no, you do have to worry about stuff, because all this chain needs their money to pay your escrows, to do all this stuff. So in a nutshell, there's a 5 to 7% penalty down here to us if someone closes now. And remember, like on your refinance, you have 3 days to rescind, to cancel. So if the rescission is May 1st, which is next Friday, your first payment is July 1st. If you're laid off in the middle of May and you didn't have any savings and you've got to eat, whatever, and you don't make that first payment on July 1st, we are charged 5 to 7% because of this.
Holy moly. Of the entire loan?
Yeah. So you're talking a $300,000 loan amount, that's $21,000. We don't make that much on these loans. You know, so the point with that, and the video, we'll just wrap that one up, is this guy, Mark Calabria of the FHFA, which regulates the Fannie and Freddie now that it's a government state entity.
What does that stand for?
Fannie and Freddie? Federal National Mortgage Association is Fannie, or you mean FHFA?
FHFA.
Federal Housing Finance Authority.
Okay.
So, you know, I'd say watch the video to really learn the ins and outs of that, but certain things need to change in this so that the message to the borrowers is, hey, you can go into forbearance if you need to, but that it doesn't negatively affect. This will cause mortgage rates to skyrocket, which then will hurt refinances, which will then hurt when people are back out to purchase. If your rate is in the 4 or 5s, people are going to say, well, maybe I shouldn't purchase. Maybe I should wait. So that whole stimulating the economy isn't going to happen.
Well, you know, and my mom said it to me. I'd been, you know, it's hard not to get in kind of the politics of all this stuff. But you know, one of the senators that caught the coronavirus, Rand Paul, you know, he came back from after his recovery after being out for a few weeks. And like first thing he got up and was saying from the floor is like, you know, you can stimulate all you want. We can send everybody these $1,200 checks, and we can, you know, free up all this money. I know we weren't printing money, but you know, definitely increase the money supply in all these different ways. But if there are no transactions, if there are there's no commerce happening, there is no economy. So ultimately, the money, it's not about the supply of money as much as it is about the flow of money. And that's something I've been saying from the get-go, is that we have to keep the money flowing. And you know, if government's going to intervene in fiscal policy, you know, that's going to be one way to do it. But still, it ultimately comes back down to these transactions. So how is that going to happen? And people lose a lot of sight of that. Like I had a lady last night. She was actually one of my social studies teachers in high school, but just still a few years younger or a few years older than me. But we kind of got into it a little bit because she was talking about the stimulus and what would happen, and I don't even remember all the background, but we got down to this point of, all right, how do we pay for all these unemployment benefits if we keep everybody on unemployment? Like where does that money come from? And she's a little left leaning. She's like, you know, half joking about it. She's like, well, you know, like we normally say, let's tax the billionaires and corporate taxes, and you know, I'm like, tax what? And she's like, oh, investments and income and capital gains. And I'm like, we tax on increases. So if everybody in the last quarter or in this quarter is showing a loss, if their assets are depreciating, there is no basis on which to tax. There is not even any tax revenue coming into the government to do all these social programs. So the key thing in the economy is the flow of money, not just the amount of money.
Yeah, so not only I want to mention the flow, but first, so one of the things you do to stimulate an economy is you take away capital gains tax. This way, we go out and we invest and we buy and I go, you know, and I buy a property that needs to be fixed up, fix it up, put it back on the market. You know, we do things like that we sell our stocks, you know, with no tax penalty so that we can get that flow going. So to talk about the flow, the analogy I like to use is, you know, it's like your human body. The economy is a living being, and your body needs blood to flow, to pump. If your blood flow stops, parts of your body die and get cut off.
Yeah.
It's the exact same thing in the economy. Look, restaurants are dying, you know, so you have to have that flow. Nothing is gonna do anything. The stimulus is just a patch on what is it? The little girl putting her finger in the dam, right? Yeah. That's all it is. And so, yeah, we need to get back to the economy as soon as possible, but do it right and safely.
Well, and I mean, that seems to be the big debate, right? Is what is right, what is safely, and how we gonna do that. But you know, sticking to the economics of things, and and to, you know, the whole thing of housing and rates. Let's go back to that question, because I know it's a very common misconception that, you know, people hear about the Fed setting interest rates, and you're saying sometimes they track together and they don't. But why specifically is it that if the Fed lowers the interest rate, and maybe explain a little bit about what that interest rate is, why don't we see the mortgage rates on new loans and refinances going down with that? How are they based differently?
Okay, so the Fed fund rate is an adjustable rate that the Fed uses to lend to banks. So the Federal Reserve is like the bank of the country, I guess you could say. And so they lend to all the banks. And if their rate is 2%, and the banks need a 3% margin, which is the prime rate usually. Well, no, not really, but they have their 3% margin. So that means your rate is 5% on a line of credit, as an example, or a personal loan. So when they lower that rate to almost zero, which, by the way, I learned this in economics, and I always remember my professor saying it over and over, the Fed actually has no control of interest rates. We think they do, but they don't. They control money supply. Yeah. So they release the funds, and the rates go down. They hold back the funds, and the rates go up. So that's why they say our target is between 0 and 0.25%, and they do that. So how does that affect your fixed rate mortgage? First of all, the Fed rate is a short-term rate. It's a line of credit. When you have a line of credit, you pull money out, you're charged interest on it, you pay it back, you're not charged interest, you pull it out a year later. So they need to charge you based on the interest at that time. Yeah. On a fixed rate mortgage, it's a long-term mortgage, and they're basing it off of inflationary fears in part, and how much they can sell that loan as a bond in the secondary market. So to tie them together, if the Fed is reducing rates and the Fed chairman comes on when they do that, when they say we're dropping it, like earlier this year, I'd do a Facebook Live while they were there and show the ups and downs in mortgage bonds as it happened. If they come in and they're saying we're going to reduce the rate because we're afraid of inflation, guess what? The fixed rate mortgages are going to go up. Why? If you're at a 4% rate, but money's going to get cheaper, right? Inflation's going to go up. They're like, oh, well, no, we can't give you a 4%. We need to give you a higher rate because the cost of we're going to lose money in the long run. So that's how they can go in opposite directions. Yeah.
So getting that, overcoming that is a big misconception. So when people kind of understand that, and really people have no idea, right? Like you take out the mortgage with your bank and you think that they own that paper, so they say, but really that's getting sold. It's getting turned into a bond that somebody else is buying, right? Mm-hmm. and somebody, just like when somebody goes to the bank and puts in money for like a CD, right? They're basically buying a debt instrument to make a amount of interest back on that, right? So that's all this stuff gets tied into it, which we aren't really taught in school when nobody really understands. They just understand, save some money, have a down payment, and you go to the bank, and then you're going to make your payments on a monthly basis, and they have no understanding of what's driving all these things and the rates that affect what for most people is still the biggest investment, or at least the biggest expense in their entire life. But we could go off on that for another thing. But let's get back down to kind of the brass tacks of what's going on right now with all these things happening. We saw your rates dip down to historic lows. The big, huge influx of requests for refinances, right? And so that was a confusing thing to a lot of people, because that was purely a supply and a demand thing, right? Like the influx of requests drove the rates back up on that supply side, because it overwhelmed the system, right? Yep. People, the originators couldn't process the loans fast enough, so they had to increase the rates just to slow down the demand.
Yep. Yeah, and actually, I put out a video because I refinanced my property in early February, and I came out saying, if I'm refinancing, it's time for you to refinance, because the rates were at their lowest. And when I locked the rate, I think it maybe went down a tad bit in the lowest point ever, which was the very beginning of March, that Monday, the first Monday in March, when the stock market started to crash and the circuit breaker went off to stop the crash. Yeah. Which, for those that don't know, the circuit breaker, which I didn't even know about, is something that prevents a crash. They just shut down the whole trading. And then when they came back on, it's so weird, the psychology, because then it started trading normally. So that's a great stop loss that they have there. But once that happened, we had the lowest rates ever that morning, and I'm calling people and texting them like, hey, we got to lock now. And I wasn't getting the answers fast enough, because in an hour, rates shot up. They went from the borrowers I was calling in the low threes, 3.1, 3.2, 3.3, depending on credit and equity, up to high fours. In a matter of days, that one week was the highest increase in rates ever in history, worse than 1987, when the stock market, 1987 was the worst crash since the Great Depression. And so we're seeing one of the worst in history. Great Recession was different, a long-term, gradual housing crash. Right. This is just an immediate stop of an economy.
Yeah, it's absolutely insane. So now let's look forward, right? So there was definitely a lot of people, and we've heard stories, and you shared stories of just deals falling through days before closing because somebody lost their job, or now the banks changed the terms. So that's another big thing that kind of drives rates or changes the whole market, right? So it's not just about the rate; it's also about the terms of lending that banks are requiring. So what are some of those changes that you're seeing right now, and how do you see those requirements lasting for the next, for the short term, next maybe 2-3 months, or is it more going to be of a long-term shift?
Estimating the time frame of it is tough. I think we're going to need to see, I think these rules put in place are going to be longer than a couple months, even though I think by June, at least I hope.
So what are some of the rules, though? What are some of the changes that maybe, like, what things were before and now what are they?
So first of all, that flood of business in February, $9 trillion in mortgages were out there, I think, which was the largest ever, caused the mortgage bonds, the buyers, like, they want the best ones. They want the ones they know are going to perform. So they stopped lending to these other side products that are not your traditional stuff. I don't want to get into that explanation, but so then other things, even jumbo mortgages, just anything over 510, depending on your area, have been completely frozen. Now, today, my warehouse line, which is a line of credit I use to fund your loan, you get a mortgage, I fund it, and then I sell it, and I pay back my warehouse line. They finally loosened some jumbo guidelines today, saying, yes, we can go up to $1 million. At the same time, yesterday I got really upset because loans that I have that have closed and that should fund because it's a rescission period on a refinance, a 3-day rescission period. We had to do a verification of employment in the beginning, verification of employment before closing, and now a verification of employment before funding. And it's like, and I get it, but it's just, it's tedious. So
Yeah.
that's part of it. The other part of it is credit scores. Some lenders are saying, hey, we can still do in the 500s, but all I've heard on Facebook groups of mortgage people is that those are nightmares. 640 is like the minimum for the most part. Chase said 700 minimum, 20% down.
Yeah.
And they eliminated HELOCs.
Wow. And
So
they're
those are
one of the larger, like retail lenders in the in the country anyway, right? And so that 20%. So, and maybe this is going off on a tangent, or maybe back into the things, but that 20% down, like I think a lot of us have heard that. That's an old traditional kind of number, or like, oh, you should have 20% down. Like that hasn't really been a reality for I think a lot of folks, and people look for 3% or some of these other things. Like, what is from your aspect, just kind of like general advice, should people really focus on that, that down payment, or, should they really just wait to get 20% anyway and not worry about that? And maybe Chase is just doing the right thing and what's good for the long-term health of the economy if more people follow suit.
So what Chase is trying to do is they're trying to make sure that they don't have any risk when they sell their loans. So they want to make sure they have the best of the best, the cream of the crop, so that when they sell it to servicing, it could still have a servicer that they sell to, even if it has their name on it. A lot of people think, oh, they service their own loans. No, they hire a servicing company and they just put their name on it most of the time. So that's what they're trying to do. They're trying to limit their risk. They're trying to make their paper more valuable, which my favorite wholesale lender, they do not do retail, is United Wholesale Mortgage, and they're doing the same thing.
Yeah.
So people that I'm saying, look, I'm just going to close it with them. I'm taking a financial hit to get them a better rate, just because it's like, let's just get things moving. Let's get them going. So that's why they're doing that way.
Yeah. So now with Chase doing that, the credit scores are still up there. I mean, if somebody was going to go in and was already looking to buy their house or to refinance, because maybe they were still up in the upper fours before or something like that, and they can still get a point reduction or something. What are the kind of the baseline things that the people should be looking at, and then the more realistic, like to get a good rate or a good deal, you need to be at kind of this level?
Sure. So I always tell people, when you hear the media saying the average interest rate right now is 3.2, they're not talking about the average interest rate that a normal person gets. They're talking about somebody that has less than 50% owed on their property. It's a single family home. Their credit is the highest you can have for mortgages, 740, 760 and above is the best rate. So let's say all those things considered, now you have that best rate. And even then, the rates that they offer, it's kind of like the rates that we get it for, because there's, even in the origination side, there's levels of, how many hands are in that to originate a loan.
Yeah.
And however many there are, the rates are higher, which is why when I sell myself, I'm like, look, it's just me. I have salespeople under me, yes, but when you work directly with me, I don't have to pay a commission and there's no corporate behind me. So looking at the base, I always say there's hits to the rate. So if you're really at 90% loan to value, which on a purchase is 10% down, your rate is always going to be higher than an 80% loan to value. And if you're in a condo, the rate's a little higher. If you're cashing out refinance, your rate's a little higher versus a regular refinance. So those are hits to the rate. So when the media says 3.2, and then I tell someone 3.7, like, what do you mean? It's every case is different. Plus every lenders right now are fearful of this. So some are like Chase saying we want the elite. So some are saying our rate is up here because we want the best people, not volume. Volume is there right now. So to answer something I didn't quite answer when we talked about Chase, someone can still put 3% down and have a great rate. 5 or 10% on a condo right now is in the high threes, because I have a client that we're doing that for on a purchase. So that's good, man. I mean, high threes for a condo with just a few percent down, that's amazing.
Yeah. Yeah. So there's still opportunities out there. You just got to have your ducks in a row and hopefully not been laid off or in the unemployment and everything else. So what, kind of pull out the crystal ball there and what do you see happening? I know you have one on your desk right there, but
one of our chamber events, Marlins. So let's ask it. What's going to happen with mortgages in the economy?
Will mortgage rates go up?
Damn it, it's going like sideways. It's going between them. Game is on, ask later. Avoiding the damn question.
that ball's a politician. But so from your perspective though, what's going to happen to if all of this kind of limits the supply of buyers, right? Or demand may still be there, but it's going to be harder to get a loan. Rates are going to go up a little bit, or the requirements are going to go up a little bit. If that limits the supply of buyers, is that ultimately going to affect prices? Do you see us seeing a decline in prices? Because obviously, one of the other things, just as kind of a plug for you and kind of the network and things you were able to do, one of the reasons we were able to refinance is because of you found an appraiser that would actually come into our house before things got really, really crazy. But the other companies that we were talking to, we just got a drive-by appraisal, and it was a $70,000 difference.
Wow. Yeah.
By the drive-by and just running comps to somebody who actually came in and saw that, oh yeah, we did this to the house and we replaced the flooring here and put in solar panels and did all that other stuff. So I mean that was a huge value obviously to us and made all the difference. But for other folks that may still be thinking about it or where do you see their appraisals going? Is this going to affect sales, and how long of a cycle does that take to actually affect things? So
I tell everyone, we know for sure right now appraisals are based on the last 3 to 6 months. So right now appraisals are going to be, we know they're going to be at a great place. So those that are saying, I'm going to wait to refinance, maybe the rates will get in the twos. There's not enough money in a mortgage for rates to be in the twos. And when they got down close to it, there were so many mortgages in process that the lenders artificially raised them. So I think waiting if you're going to refinance is not the right thing to do. We don't know how much stricter guidelines are going to get. That's on refinances. If you're purchasing a property, I do not think it's a bad time to purchase. And I'm not saying that because I'm trying to get people to buy. I lived through the market crash in this business. It's all I did. I didn't go work at Starbucks while I was doing it. I suffered through it. And so I saw what that was. And this is not that. The housing market was strong. The housing market will continue to be strong. Rates are some of their lowest. Back then, rates were like at 5 or 6% when the market crashed. So what I see is, yes, you look at Zillow. I have little grids that I make on Zillow just to see more like investment properties. I want to see the rundown duplex and what they're pricing for right now. And you see 5,000 reduction, 1,000 reduction, 20,000 reduction. That's more like at $1 million or 700,000 that have that reduction. So you're seeing these sellers that need to sell reducing. So, but are they reducing lower than what the value was, or are they bringing it down to the value? A realtor we know, Drew Kern, will tell you they're bringing it down to the value. And he really has a good hand on the pulse of the market. Now, the example I've been giving, we look back 12 years ago. We had buyers and sellers, right? We actually had a ton of buyers trying to buy properties on these sellers, which we saw right before COVID-19 really took effect. So that causes prices to go up. Now, buyers plummeted to almost zero, which means the sellers had to bring their prices down to meet them halfway before they started buying. That was the crash. Right now, what we're seeing is sellers are saying, I don't want people in my house. Buyers are saying, I don't want to go looking for a house because I don't know what's going on. So what are we, we're not seeing all these sellers desperate. We're seeing kind of normal. And when we come out of this is when we're going to see, that's when we can really gauge where the market's going to go. That's why it's important for things like this to help us through forbearances so that the mortgage market is still strong and can lighten up a little bit. I don't even like to give people mortgages if their credit is under 640. I tell them to go to our friend Chris Colson and get their credit fixed because their rate is like a 1% higher. It just, a little bit of discipline for a few months.
Yeah, and 1% on a 30-year mortgage is not the same as 1% on your credit card, or something like that. Yeah.
So to finish that off, I think we'll see some drops temporarily. I do not think we're going to see anything what we saw before. We might just see flat national averages flat throughout the rest of this year, and then 2021 maybe pick up. If you look at all the stats of previous recessions, which I've been studying over the last few years, because I've been saying there's a recession coming, I had no clue it was because of a virus, but it came in the year I said. I got lucky in that sense, but it's here, and all the previous recessions, the only one that has seen double-digit reduction in value was the last one, and in the last 5, there was one in the 90s that had a 1% reduction in value. I'll take that any day, a flattening for a year.
So, all right. Well, that I think that's good news for anybody who's maybe thinking about that refinance. And so kind of the key takeaway there is don't wait, because it's unlikely to get any less than 3% of where we're at. But the other thing, and this was one of the concerns that I had, is we got our appraisal, right? We got our underwriting, everything. You said like, oh, okay, yeah, that's good for 4 months. Great. Well, I could have taken that appraisal and gone into June and thought about that. But my big concern is, well, everything could change, between now and then. And they just might stop lending or might want some ridiculous, reserves or something. We had to shift a little money around and put some
3 or 6 month reserves, because they want to make sure that, okay, you lost your job. Can you pay this mortgage for 6 months? And I tell people all the time, this forbearance is not a free lunch. It's not hey, I want to save some money for the next 6 months. No, the negative impact secondary market, negative impact to the individual, just because the government's saying that the credit shouldn't cause it as a default, they can still look at it as a default. Now, you have a bad mortgage now. So you're going to be treated differently. And, okay, maybe it's not going to hurt your credit because we can remove it from the bureaus, but, it's not something.
Well, it's still, and it's one of the biggest things, right, is it's not, the federal government moves on something. Everybody still looks at, how is this affecting me, right, and personally, but it's a massive effect on a huge system that ultimately can be very, very fragile in a lot of different ways, right? And so if that one person defaults or does that, it's good, or it sounds good to have these protections that you can't be evicted and all that kind of stuff, but the money still has to flow. So where is it going to come from? I think is still kind of the key question around all this. So to that end, this is kind of going back into the broader aspect of some of the economics, right? So you talked about the Fed doesn't actually control interest rates; they control money supply, and I think that's a very nuanced thing that a lot of people don't understand. But obviously, all this stimulus kind of came out of thin air, and people are asking the question, with the $2 trillion, they just like, where did we get $2 trillion from? And why are we not doing that? Or why do we have this huge deficit? If there was $2 million laying around that they could pump into the economy, and I know we got into a discussion on this on Facebook a little bit, and because I just kind of loosely used the term printing money, but it's not exactly printing money. So let's talk about that a little bit. Like where did all this stimulus money come from, and how is that in maybe your opinion or outlook on things? How is that going to affect the value of the dollar, inflation. What should people be looking at in other economic terms on maybe how it will come back and ultimately affect them.
Sure. And I'm, excuse me, I'm not an economist. I've got a degree in it and everything. So there's some things I don't fully understand. Most of my knowledge is in relation to the mortgage industry.
Sure.
But I do learn every day, and I see articles and usually things related to mortgages, and then I'll go off and I'll read a little bit here and there. So first thing, you talked about the debt the country has. Debt is not bad. It allows you to do other things. Even for us, debt is not bad, because I could have leveraged debt over here, but I have cash flow over here to make more investments and make more money. Because if your debt is 3%, that's almost inflation. Keep that debt, So debt is not bad. Having this trillions of dollars in debt is not a terrible thing. We're not going to collapse because of it. The money that we do have, here, an example is when I talked about when we bailed out Fannie and Freddie 12 years ago, and they became government-sponsored entities, which means they were being controlled by the government. Part of that contract was the government profits. So we spent $191 billion to bail them out. Men have profited $301 billion. That number was like in January or February, so it's probably even higher now. So it's not a bad thing. There's money in places that it's not spent and gone. It's not like you went somewhere and blew all your money and it didn't go back into the economy. Part of what they do is they sell bonds to create money. Right now they're buying hundreds of billions of dollars in mortgage bonds. So eventually they'll sell those to get more money and they'll put them in the coffers or whatever they do. So I learned we didn't print money because one of the experts that I follow two that are MBS, mortgage bonds, mortgage-backed security experts. And so I get two viewpoints on that. And one of them was like, UK, 2 weeks ago, maybe UK just started printing money, which is very dangerous. It's what, Argentina and other South American countries do, that then their value of their money just completely falls like that overnight.
Yeah.
So we're not doing that because it is dangerous. I think that's a last resort. So there's money stuffed under the proverbial United States mattress, I guess you could say, and it comes out in moments like these. And it's why our economy continues to be one of the best in the world. And when we come out of this, we're going to come out of this strong, while others are going to lag behind.
So that's it's an interesting point. It's definitely one perspective. I mean, I'm sure when we post this on Facebook, there'll be plenty of people that might want to say that carrying all this debt of the big national debt may be not that wise. So one of the things, and now we can really get nerdy. In doing this at the end, but one of the other things that people don't understand is, people talk about Fort Knox and stuff, and used to we were on the gold standard and the
gold bullion,
yeah, and all of the money, all of the money that the Fed printed out or bought bonds for or whatever it was, whatever money was in the supply was tied to an actual physical asset and the amount of gold, and then we got off that back in 72, and all the other countries basically do the same thing. And so when we talk about the dollars based on the faith and goodwill of the U.S. government, our friend James Schulman pointed out the other day, it's like a little more nuanced than that. It's the faith and goodwill of the U.S. taxpayer to continue paying the taxes, which ultimately pays the interest on all that bond debt that we sell to increase the money supply. But the other thing that is key to that is that the U.S. dollar is still the reserve currency of the world, right? And so all of these other countries, they ultimately trade back and forth, but it is all pegged to the U.S. dollar. So just like we used to tie the U.S. dollar to the value of gold, the value of a lot of these other countries get tied back to the U.S. dollar, and then you get into like petrodollars and all sort of stuff. And my mentor is actually an Australian Canadian, something like that. But lives down in Australia, and he's been saying for a while, the real world war going on is the financial world war, and the goal of some of these other powers is, not so much about the American people and all this other stuff, but it's to knock the U.S. dollar out of that reserve currency position. Because if the value of all the other money in the world is tied to ours, and we can't just increase our money supply as easily as some of the other ones. So again, beyond my pay grade when it comes to economics and finance, but I think there's some other interesting things that are going on in the larger scope of things that we lose sight of. We're just thinking about our economy and everything, but ultimately everything still is global. Mm-hmm. and all this money flowing back and forth, all these things that we print, our economies are ultimately very local and what people are doing. But, these decisions that are being made, they're largely much larger than even our own country and what our currency is, because it's trade back and forth. Money's going back and forth in goods and services and all these other different aspects that are coming in and affecting that. And ultimately, it does have a real effect down on us and our spending power and the things that we do on a daily basis. But it's still largely out of everybody's control. So the best thing that you can do is just to educate yourself about it, to be aware. That's why we're having these conversations, so folks on our networks can maybe learn a little bit more, maybe get at least a glimpse or an insight into something. That there's plenty of information out there on the internet provided by folks like you or other resources, and all we can do is go in and empower ourselves to be able to make the best decisions, understanding what the environment is out there.
And reality, all you can do is control your own economy. We don't have 1 out of 300 plus million in the U.S., 1 out of 8 billion in the world. We don't have control over all that. All we can do is control our own. And I think one of the biggest takeaways is something I said earlier, is you have to prepare for a recession. You can't think things are great and it's never going to happen. Or you have to have an emergency fund. You have to have 6 months. If you lost your job and your expenses every month are $5,000, you better have $30,000 in savings. That needs to be a 6-month reserve somewhere. It could be a 401k that you borrow from. It doesn't matter. But that's the biggest thing. Because then if you're okay for those 6 months in this thing, then you're good. You're not one of the ones bringing the economy down. You're one of the ones helping the economy, survive.
Yeah. And realistically, that's when a lot of the great opportunities are. Like if you've got that 6-month reserve and you've got your cash flow to do other things. I mean, look at all the opportunities that people that have understood that or made those choices in the past to be in that situation. Look at all the opportunities they have to maybe pay off higher interest debt, to go and invest things, and even in something like home improvements and stuff like that. We've all got a lot of time, but if you don't have the cash to do those things, it's going to be a little bit more difficult as well. So that ultimately is the key thing for a lot of us is understand how the world works, understand how the money supply works, understand how it affects you, but ultimately understand what you have control over. That's a key thing. So I know we both have meetings to get on to coming up to the top of the hour here. So any other last minute bits of advice for folks, or outlooks, insights on what they should be doing around their mortgages and home purchases and how we should move forward with this?
I think if you're still employed and you're good on money and you can spend, not exorbitantly, not irresponsibly, but think about who your local small business restaurants are and go have takeout. And I need to stop eating takeout, but there's other things. There's people, I'm calling a guy that I know that's in one of our groups that is a personal trainer, and we've been playing phone tag. But I'm going to say, hey, what can I do to, I want to use you when this comes out. Would it help if I bought a gift certificate from you right now that I can. You know, things that we can do to help each other's economies, you know, to keep things flowing. But if all you do is sit there and you're hoarding completely, to an extent, we need to save, you know, but at the same time, if everyone is only hoarding, then it's terrible.
So, you know, get back in a secure position. If you didn't have your emergency fund, if you didn't have your savings, and you're still getting that income, things haven't drastically changed for you on that financial outlook. This is the time to get into that position. And then after that, like, continue letting the money flow. I think is you know, I think that's great advice in terms of being able to help everybody else out, and ultimately to make all these things happen. So, you know, I think it was great. We were able to talk about this, and you know, for a long time, not even really talk about the virus and everything, just focus on the economics of it. But
I forgot my mask today. I'm driving over here, rushing to the office with my daughter in the car. I'm like, Dad, I forgot my mask. But
you know, you can just rip up that jersey, you know,
tie it around my face.
That might be a better use for it. But we'll leave it off on there. And so, if people want to get in contact with you to talk about that, how can they reach out?
My website is pslending.com. You could also on Instagram, mortgage_nerd_TM. You know, Phil Stevenson, mortgage nerd on Facebook. You know, and I'd say check out the videos, like, share, subscribe. You know, I believe in real content. Some of it is funny. I'll dress up as an abuela or an abuelo. I'm half Cuban, and you know, make skits out of it with my low budget filming. It's all self-done, but I have an editor, one of my employees, and you know, that's it. Just watch the videos and share them, and that's really growing. And like you said, the credibility and the knowledge is really what it's all about. So if you're in business too, you're not doing videos, you're behind the curve. You have to start doing them.
Have to start getting out there. Well, we hear the tone from my computer letting know that it's time to move on. So we'll go ahead and sign off here. Phil, thanks again for taking the time, and I hope everybody enjoyed and learned something here today.
All right. Thanks, Will.